Hi, everyone. Happy Thursday. I hope the sun is shining where you are. Here in Toronto, it's been feeling like summer again, which is really nice. We're also a day after the Bank of Canada policy rate announcement, and in my opinion, it's a great day for business credit trends. Wouldn't you agree? So today I have a real treat for you all. As always, I will be joined by my esteemed colleague and the Equifax Commercial Line of Business Lead, Jeff Brown. We will also hear from Carmen Allison, VP Business Development at Nielsen IQ on retail shopping insights. Carmen and I are actually former colleagues, and he will be taking us through insights on changing consumer shopping behavior in light of recent economic factors and the impact on Canadian businesses. But before I get too far ahead of the agenda, I'm going to pause here for some housekeeping items. Jordan?
Thank you, Sinead, and good afternoon, everyone. Thank you all for being with us today. I'm here to provide you with a brief overview of the platform that you see in front of you. For some of you that this will be a review, I'm actually seeing some familiar names from our previous Consumer Trends event. Welcome back. If you have joined an event of ours in the past, please hit the thumbs up in the reactions bar at the bottom of your screen. Okay, so this area, this On24 webinar platform is responsive so that you can maximize or minimize each widget or box on your screen based on your viewing needs. There is an Ask a Question widget underneath the media player, so feel free to enter any questions you may have, and we'll try to address them throughout the session today. In the event that there are too many questions to get through, we will reach out to you individually to follow up in the coming weeks. Today's presentation in English and French is available for download in the related content area. The session is being recorded as well, and you will receive the on-demand link via email tomorrow. So there is a little box on your screen as well where you can register for our upcoming Market Pulse Fraud Trends event on October 2nd, where our fraud consulting director, Cheryl Prince, will be highlighting fraud data across the auto, banking, telco, and mortgage industries, along with much, much more. Some additional features you'll notice at the bottom of your screen. As I mentioned, reactions. Please let us know how we're doing, what you like, what surprises you. Our contact us and survey. You can fill that out during or after the session. Feel free to check any of these buttons out. Provide your feedback. Even if you've done it before, we really appreciate fresh comments. And with that, let's get it started. Sinead, back to you.
Thank you, Jordan. Okay, so today we will look back at the second quarter of this year. In real time, many of us are well back into the swing of our daily routines after a very hot and dry summer. We finally got some relief from the heat. The rain came back and the trees are now actually starting to turn those beautiful fall colors. But this afternoon we'll be squarely focused on those hot and hazy days of the summer that was 2025. You'll recall that during the second quarter, trade tensions remained in the headlines, wildfires burned, again for Canada's second worst wildfire season on record. And just as the summer was wrapping up, labor disputes in the airline industry caused disruption during peak travel season. So let's take a look at the macroeconomic data that resulted in the second quarter. So for the first time since 2023, Canada's GDP contracted by roughly 0.4%. The contraction was concentrated, though, with the weakness largely contained within trade-exposed sectors, like manufacturing and wholesale trade. StatsCan reported that business investment declined, driven by a 9.4% drop in machinery and equipment investment, but domestic demand was up by nearly 1%, driven by an increase in household spending and an increase in residential investment, which was largely due to an increase in new construction, primarily in BC. And on this slide here, we're looking at the difference between the balance of payments on exports, which is the blue line, and imports, which is the yellow. Unsurprisingly, we now see a considerable gap between them, and by April, the trade deficit reached a historical high. And this was largely driven by a contraction in exports in multiple key sectors such as energy products, motor vehicles, and consumer goods. Exports of passenger cars, light trucks, industrial machinery, and travel services were particularly hard hit. And in the second quarter, we saw headline inflation ease to 1.7%, driven by a significant drop in gasoline prices. Core inflation, though, remained elevated at 2.5%, with prices on essentials such as food up by 3.3%. Shelter costs were up 3% overall, with rents in particular growing at 5.1%. And the Industrial Product Price Index continued its ebb and flow climb upwards to 2.6% in July, indicating continued strain on production costs for businesses. Raw materials were up 0.8%, driven by a growth in animal products and precious metals. But the growth rate in prices was driven by a broad range of items, as certain things saw significant growth, such as lumber at 12%, beef 16.5%, and precious metals at almost 34% price increase. And then on the labor side, employment levels continued to fall, reaching a 6.9% unemployment rate in June. Industries with the highest job losses included professional, scientific and technical services, transportation and warehousing, manufacturing and educational services. And then the industry which reported the largest positive labor growth was construction. Many trade-exposed industries contributed to the overall job declines, but businesses were also more cautious this past quarter when it came to hiring. And add a slowing of population growth into the mix, and the overall result was a weakening in Canada's labor market. Okay, and then just quickly looking regionally, the elevated unemployment levels were generally widespread, but demographically, it's the youth unemployment rate that really stands out here, having hit 14.5%. Okay, then in terms of net business growth, things actually remained relatively stable. Here we're looking at the difference between business openings and closings. But looking at the drop at the very end of the graph there between March and May, sectors that are dependent on foreign demand like mining, oil and gas extraction, and manufacturing experienced a sharper decline, which contributed to a higher business closing rate in that particular period. Consumer credit card spending was around $2,000 a month in July, which is similar to the last few years. Between May and June, spending was up 1.5%. The increase came from spending on essentials and less so on discretionary spending. Categories like gas, groceries, supermarkets, convenience and vending, those were driving the bulk of that growth. Pardon me. But the more nice to have categories such as motor vehicle and parts dealers, specialty foods, furniture, those types of things, they had much lower growth rate. Okay, I will now pause here, pass things over to Jeff, who will walk us through this quarter's Business Health Index numbers. Jeff?
Perfect. Sinead, thank you so much. As we've done in the past few quarters, we talk about the overall health of Canadian businesses, not just from a credit performance perspective, but from a growth projection, sentiment, and environment as well. So when we go into kind of the deep details here on credit, it's important to have context about what else is going on. So we've developed this index in coordination with the Business Development Bank of Canada, and this is something we provide on a quarterly basis. Moving forward, we will also be providing this index based on specific industries as well. As we go through this economic uncertainty and trade uncertainty, it's becoming more apparent as we talk to organizations about scorecards, about where they need to prioritize, where there's high risks and where there's opportunities as well. So that index is going to provide some direction on that as well. So really what we're looking at here is a quarterly snapshot of the health of Canadian and medium small businesses. What we're looking at here is a trend on the health index on the left and the elements that make up the index on the right. In Q2, the health index declined 1.6% compared to Q2 of last year, driven by insights and trade tensions that really widened the deficit levels in Canada. At the same time, lower inflation and interest rates really offered some relief, helping certain businesses strengthen their overall credit performance. Among the four elements that make up the overall index, there are three elements that see a drop. So by 1.7%, 2.4%, and 12%. Really what's pulling this down is the overall sentiment. So as we look at things in the news, as we get updates on tariffs, it's really something that we has really measured into the overall surveys that come back from small businesses. So the outlook for small business, the optimism isn't at its normal heights compared to what it was a year ago. Meanwhile, for the environment factor, lower inflation, recent interest rate cuts has provided a bit of a sense of relief, contributing to a 10.2 improvement in the macroeconomic environment, really boosting their overall credit performance. So again, one thing that we really need to think about is the second part of the year, as Sinead was talking about, we were going through wildfires, there was a lot of uncertainty. And while there was buy Canadian programs out there, the reduction in consumer spend has really kind of brought down the overall sentiment from small businesses across Canada. When we look at this from a national point of view, and we're going to see this more as we go into the credit side as well, is there's a few things that are happening across the country. So we're seeing uneven impacts in terms of where things are happening on the industry side, but as well as provinces. Provinces that are typically really, really strong for us, like Ontario and BC, we're actually seeing the largest hits in terms of credit performance as well as impacts on future sentiment. So Ontario and BC, they've really been at the heart of some of the trade disputes that have gone on here. And really what we're hearing from small businesses as well as large suppliers and the banks is that there's a look towards that fall economic federal budget update. So we're hoping that as that budget comes out, not only is it going to pinpoint into those areas, but it's also going to put something into place sooner rather than later. So as we see a decline in the overall index, there is a light at the end of the tunnel, or a silver lining to this, that we've seen the right signs from the federal government that they're looking to invest and target, but really we are seeing some notable stresses specifically within Ontario and British Columbia. So with that, I'll pass that back to Sinead.
Thank you, Jeff. So to recap this quarter's economic highlights, we saw lowered economic investment by businesses as Canada experienced a significant shock with exports. The cost of producing goods continued to climb, putting additional pressure on businesses. The unemployment rate climbed to 7.1% overall, with the youth demographic being especially impacted, and consumer spending concentrated on essentials. Businesses in trade-sensitive regions such as Ontario are starting to show signs of financial stress. And then overall, it's a tougher environment for businesses this past quarter. Let's now look at the credit trends themselves and see the impact that this environment had on the credit landscape. So the average debt per business grew in the second quarter to an average of $33,000, up from $29,000 the same period last year. Notably, looking at the middle of the graph on the left, businesses who've been established less than or equal to 48 months saw a significant 43% growth in balances. And a switch from what we'd been seeing last quarter, we now see balance declines on cards and lines of credit. Installment loans are the key driver of the overall climb in balances, which grew by nearly 10%. Unsurprisingly, we saw reduced demand for credit again this quarter, everywhere except for in the dead center of the country. Overall, demand was down by just over 1%, and the only key industry to report any growth was in the agriculture, forestry, fishing, and hunting sectors, which reported a 6.1% increase in credit demand over the same period last year. And as a result of that reduced demand, account originations declined this quarter compared to Q1. And compared to the same period last year, it's down almost 6%. There has been reduced demand for more costly or unpredictable forms of credit, like cards, lines of credit, but the lowering interest rates would be making installment loans a more attractive option right now. But it also points to sort of what we saw in the consumer spend shifting to more on essentials. Businesses are likely focusing on the essentials too, as the changing trade dynamic is impacting the way businesses are operating. On the left side of this particular slide, we see the number of businesses that have at least one missed payment, and that has grown again this quarter, surpassing the numbers we had seen in 2021. And on the right side, we see the average balance per business has grown too, with cards and loans reporting double-digit increases. The average balance per business on cards sits at just over $6,000, and on installment loans, it's just over 128,000. So the debt burden definitely increased overall this past quarter for Canadian businesses, and it's showing up in repayment behavior strain, I should say. So in terms of business growth this quarter, things are a bit stalled with a dash of caution thrown into the mix. The Business Health Index reported an overall declining business sentiment. Lowered interest rates have likely helped with the account originations, although originations are still lower than the same period last year. Most key industries reported a decline in credit demand this quarter, and we saw debt levels growing alongside an increase in delinquency rates. So let's now look at the difference between the supplier side and the banking side to see how things are shaping up that way. So first, we will look at the supplier trades, and those are the things that we refer to as industrial trades. On the left side of your screen here is the delinquency rate trend by quarter. And on the right, we're breaking down the later stage delinquencies by province. What we see is that delinquency levels remain fairly flat this quarter, with later stage delinquencies declining across most provinces. Although the delinquency rate is still elevated, it has come down since that peak in the fourth quarter of last year. Businesses are keeping their supplier relationships strong by prioritizing these payment obligations. This is in contrast to what we're starting to see on the banking side, however, where here on the banking trades, we see the delinquency rates continue to climb up, reaching 3.68%. Later stage delinquencies on financial trades are up in every single province. And this really underscores the pressure that businesses are under right now, as even on these financial trade repayment obligations, we're seeing a growing cause for concern. Breaking down those delinquencies by product, last quarter we reported financial delinquencies were driven by cards. But this quarter we see a large increase in delinquencies on lines of credit as well. Later stage delinquencies on lines of credit have grown from 2.8% to a significant 4.19%. And this is true for all ages of businesses. By sector, we are seeing consistent trends. Accommodation and food service, along with transportation and warehousing, report the highest levels of delinquencies, proving to be the industries that are under the most repayment strain. But in fact, all sectors are reporting growing late-stage delinquency trends. And then last but not least, looking at insolvencies, nationally, we see a little bit of easing, largely due to a softening in proposals as opposed to bankruptcies. Okay, so to recap this quarter's highlights, the big theme is strain. Businesses are reporting increased levels of delinquency as unemployment rates rise, input cost increases, and trade uncertainty continues. We see supplier repayment levels flat while businesses aim to keep doors open and keep goods and services moving, but increased cause for concern with the growth in delinquencies on the banking side as delinquency rates are on the rise across the country. Some industries were particularly impacted. Key industries like accommodation and food service, agriculture and manufacturing face significant headwinds due to the worsening economic environment. And so what can lenders be thinking about right now? Well, as always, continue to assess your portfolio's performance, especially critical right now with the numbers that we're seeing. You can leverage the business health metrics, which include growth, performance, and business sentiment alongside macroeconomic indicators to assess risk. There will be some industries you're going to want to monitor a little bit more closely, like hospitality, manufacturing, and resource sectors. Check out the link in the platform for information about our business portfolio health check on that one. And then also for any businesses who might be watching us today, you can check your own credit performance to get a view on how lenders assess your risk profile by visiting the Business Credit Report Direct page on the Equifax business website. This is going to give you the same information that lenders see, so you can take charge of building your credit profile. And then one of the trends that we saw this quarter was the impact of consumer spending on essentials. Consumers are feeling the pinch each week as they try to make more informed shopping decisions. And a lot of the trade uncertainty is playing out in real time in the grocery aisles as Canadians make very different, almost patriotic even, purchase decisions, more so than they've, I think, ever made before. So time now to hear from our guest speaker, Carmen Allison with Nielsen IQ, and to go deeper into the world of the consumer packaged goods industry. Hi, Carmen. It's so great to have you join us. Can you introduce yourself and share a little bit about Nielsen IQ, and then take us through the trends that your company is seeing and how what we just saw on the credit trends might be showing up at retail? You know, I'm sure it's impacting things more than just with an elbows up mindset, and I'd really love to get your take on how trade uncertainty is impacting Canadian manufacturers and retailers. Carmen, over to you.
All right. First of all, thanks, Sinead. It's good to join everyone today. Now, Sinead, it was interesting actually listening to your presentation. It's my first time seeing an Expofax presentation, and you know, you just confirmed that I'm normal in the sense that I also spend about $2,000 a month on my credit card. So that was actually made me feel a little bit good about whether or not I spend a little bit more or less than average. Now, as Sinead mentioned, you know, there's obviously this big movement right now around Buy Canadian as it relates to consumer sentiment. And, you know, it's probably the number one question I get from our clients and also from the media, you know, and we just turn on the news. We see this as a common thing. As we go into the store, we see it as well. We talk to our friends, we hear it. And that whole elbows up around whether or not we're being patriotic and buying Canadian products. We know we have that sentiment to buy Canadian, but the question is whether or not that's actually impacting sales within the grocery store. So before I get into some of the data, I just want to provide a little bit of insight as far as who NIQ is, or Nielsen IQ. Basically, we have a very simple goal. Our goal is to help our clients grow their business. And how we do that is providing research data, also insights, allowing them to make more strategic business decisions. Now, we are a global company. We're in over 100 countries around the world. Our primary focus is the grocery sector, or as we call it, consumer packaged goods, or FMCG, which is fast-moving consumer goods. You'll hear those terms. They're very interchangeable. But think about when you walk into a grocery store and you walk up and down the aisles, that's the products and the categories we're typically measuring, both for retailers and for manufacturers around the world. So what are some of our capabilities that we have? There's a whole slew of insights and capabilities we have for various customers. We're just going to kind of focus on two areas today that we have. First of all, we have market measurement. So at NIQ, we have retailer cooperation from the majority of the grocery retailers in Canada. Well, what does that mean? Well, we're getting their point of sale data weekly. So think about Loblaws, think about Metro, Sobeys, Shoppers Drug Mart. Those are the retailers that we're having our sample, that we get the data and we are processing it 1 week after period close. So the information I'm going to be showing you is quite current in the fact it's going to be showing some of the sales results for August. So there we look at things like, you know, growth, market share, performance, pricing, all of those kind of metrics. When you think about when you're scanning your product at the checkout counter, that's the information that we're capturing in order to report back to both retailers and also manufacturers. We also understand that, you know, consumer behavior is a big important driver of sales as well. So we have a consumer panel. We actually have two of them. We have our home scan panel, around 12,000 households. We also have an omni panel. And with there, we have upped our sample to almost 35,000 households. And there we're getting to things like demographics, purchase behavior, understanding consumer loyalty, and also understanding consumer switching that's happening. Consumers right now are switching between brands, they're switching between stores, looking for the best deals overall. Now, I'm not going to go into detail on the information on the right, but you can see there's also a lot of other information and research that we can provide for our customers. So I talked about some of the retailers. So some of our customers on the manufacturer side as well, think about any brand that you're seeing within the store, like Procter & Gamble, Nestle, Unilever, Coca-Cola, Pepsi, as well as a lot of other smaller players. There's around 3,500 manufacturers that's in the grocery aisle, and the majority of them are definitely working with NIQ as well to help grow their business. So first of all, let's kind of level set and get a sense of what are some of those big trends that are influencing the marketplace. And as I kind of take you through these, you can probably relate to these as it relates to your own personal household or even the neighborhood in which you live. So we do a survey and we want to understand consumers' ability and willingness to spend. So what we're seeing here is about 42%, so 4 out of 10 households, say that they're worse off financially than a year ago. That's a big concerning number. Now, we have about 10% of us that say we're financially better off, and about 38% of us, the balance, that say that our financial situation is similar for last year. But what we're seeing here is that from the majority of the households that we're surveying, we're seeing the largest portion say they're worse off than they were a year ago. And this is really what's fueling a lot of the trends we're seeing. Consumers are buying on promotion. So think about every time that scanner is beeping at the checkout counter, almost half the time the sales are associated with some type of promotion. Now, I used to do North American research for both Canada and the US last year, and this number was always shocked Americans. And I always say Canadians are promotional junkies. We love a good deal and we constantly are shopping on promotion. So think about that half the time we're buying something because it's on sale. If you look at the bottom there, about 55% of units are sold on promotion. So more than half of our basket is definitely influenced by promotion. We also like to buy on deal when it comes to deciding where to shop. We are still looking for those lower price points. And we've now hit the 50% level. If you think about retail trade within Canada as it relates to the grocery sector, about 50% of those dollars are going to discounters. Now, what is a discounter? A discounter is retailers like No Frills, Freshco, Walmart falls into that definition as well. So think about those retailers that typically have a go-to-market strategy that has a lower price point. All the major retailers in Canada have a tiered approach, right? They have their premium format, their mainstream, or we call conventional, and then a lot of them also have a discount format. And that's where we're seeing a big shift, and their growth is up about 5% versus a year ago. Now, as I alluded to in my title slide, which is really what's going to be the crutch of the rest of our presentation, is the fact that we have value. We were looking for value, but we're also deciding on what to buy based on our values. And this whole Buy Canadian movement has probably been the biggest trend that we've seen that's hit and shucking up our industry in the last year, probably in the last 6 months. So we have about 44% of Canadians that said that they're going to only buy Canadian products or boycott US products. So that number is quite large. So we're going to dig into that one a little bit more to understand, is this really, is it, and we're basically the wallets following the consumer sentiment around choice. Now, this Buy Canadian movement is getting a lot of momentum. And as consumers, when we walk into the store, we're now seeing a lot of pro-Canadian movement. When we go on social media, we're seeing these Buy Canadian conversations pop up as well. We're seeing tariffs logos and brands that are shouting loud and proud that they are Canadian. Even if they're not a Canadian manufacturer, they're still creating awareness around the fact that they manufacture or make their product in Canada. As well. So that's really been the big change that we've seen around how retailers and manufacturers have been communicating and reaching out to consumers. So at Nielsen IQ, we started a survey. We do this quarterly, and we do it both for Canada and the US. So this is the Q2 results that we just did our survey back in June. And we asked, are you aware of tariffs? And basically everyone is aware of the fact that we are now being tariffs, right? And it's hard to avoid that topic when you turn on the news. Now, the question is whether or not Canadians feel it's going to have a negative impact on their lifestyle and daily life. And what we see is about 89% of us say, yes, it's going to have a negative impact. And we see a slight change here. It's down 2 points from earlier in the year in Q1 in March. But the biggest change we're seeing is this negative impact. About 39% of us said it's going to have a negative impact, and that's down 12 points. So I think a lot of times we were scared by hearing this 25% tariffs. And I think a lot of us had that elbow up approach. And we were really, really concerned what it's going to have, the impact it's going to have on our pocketbooks. It has had an impact on the pocketbooks, obviously, but maybe not to the degree, because a lot of manufacturers and also retailers have absorbed some of those cost increases well and haven't transferred a lot of those price increases onto the consumer directly. I'm not saying we haven't seen inflation. We've seen inflation, but not to the 20-25% that we've seen for some categories that have been impacted by tariffs. So we know that, Canadians have been mobilizing and we're becoming very, very label conscious over the last 6 months. So with social media, I don't know if anyone on the call has joined this group, Made in Canada. I joined just to see what all the fuss was about. Now this group, I think, is up over 1.2 million Canadians. And to be honest, it's almost a vigilante group to a certain extent, and in the sense that we want to promote Canadian, but there's a lot of confusion out there as well. So people are saying boycott Fairlife because it's a Coca-Cola product, and then people are jumping in. Well, no, they manufacture using Canadian milk from Canadian farmers, and they have a factory and facility in Peterborough where they employ Canadians. So there's a lot of confusion out there, and even people are saying boycott Nestle. Well, Nestle is not a Canadian or an American company. It's actually a Swiss company, right? So this one is just interesting to get a voice of what consumers are thinking. And to be honest, there's a lot of confusion out there. I think Canadians want to do the right thing, but there's just a lot of confusion. So we've seen packaging change, right? Where now packaging is putting, proudly Canadian on it, or the Canadian flag logo on it as well. But there's also been instance of maple washing, and there's a class action lawsuit that just got announced yesterday in the news as well about the fact that, consumers want to make the right choice, but sometimes they feel that they're not being told the correct response as well. So at the shelf, we've seen this explosion as well, where Made in Canada, or the little Canadian flag, is now right next to the product and the price point. This is one thing when I shared with my U.S. counterparts, they were like shocked, and we had some colleagues up from the U.S. a couple months ago, and I took them into those stores just so they could see it firsthand. And so this was something that we're trying to create awareness around the fact that a lot of these manufacturers that we deal with, they have North American divisions, and they are responsible for Canada and the U.S., and it's important to understand some of these shifts that are happening because it's definitely impacting their sales. We've also seen this pro-Canadian advertising. I like this one because it's just one that says made with 0% American cheese. So this was just an example of how even advertising has been changed to kind of jump on the bandwagon as it relates to consumer sentiment. And then retailers have been really, pushing the agenda as well. And this is just a snapshot of different retailers around Canada and what they are putting in their store flyers. And we typically see paper flyers, but obviously a lot of flyers now have moved digital, right? And consumers are looking at their apps and deciding what to buy. And we tend to scroll through those weekly ads as well, looking to what we're going to buy. So not only looking for promotions, but we're trying to create an education around what is Canadian. So there's an example from Sobeys, Shoppers Drug Mart, No Frills, IGA in Quebec, Walmart, Metro. They're all supporting these Canadian brands in order to win over the consumer wallet overall. So part of the survey that we've done at NIQ is once again, not only understanding consumer sentiment around tariffs, we're able to do an analysis and cluster consumers into these attitudinal segments. So there's 4 consumer segments, and I'm just going to start at the bottom here. And 4% of us said, it has no impact. I don't care if it's American or Canadian. I'm not changing my behavior, right? So only 4% of us, and that number hasn't changed. So if we start at the bottom, work our way up, we have about 30% of Canadian households that say they're American good avoiders. So the key word there is that they're just avoiding American-only products. That's down 7 points. It was 37% in Q1, and it's dropped to 30% in Q2. So part of the reason there we've maybe seen a drop is because it's hard to potentially consumers have been motivated by promotion, or there's a brand that they just love. And maybe they thought they could boycott it in the short term, but now they're coming back to buying those products as well. So what's different from this one is that they're going to boycott American products. And then what it means is they'll buy anything but American. So they're buying Canadian, they're buying product of Mexico, Italy, etc. So those are basically the key definer of this one is they're not buying any U.S. products. The next group, 52% of us, and this is where I would probably fall in as well from a consumer perspective, which is the largest group, is these pragmatic Canadian supporters. So I want to put my best foot forward. I want to be patriotic and support Canadian businesses as much as possible. But if there's no option to buy Canadian, then I will, potentially buy that U.S. product as well. And if you think about our industry and we look at some of the top manufacturers in the grocery store, it's dominated by U.S. players, right? So that's important to understand here that there's a lot of brands that are potentially impacted here. So Canadians may be, for some categories, still switching and buying Canadian, but for other categories, they're still buying some of those U.S. products overall. Then that leaves us with about 14% of us that are truly Canadian loyalists. down 3 points. Now it's down only 3 points, but this group is a very hardcore group. These are consumers that are saying they're only going to buy Canadian and nothing else. If it's not available, they're going to do without. So I always make the example, well, if you love mangoes, and obviously we don't grow mangoes in Canada, then mangoes are off your grocery list, you're not going to buy them again. So that's just an example of a product that consumers may be cutting. Now, the question is, like, this is attitudinal based, right? And these numbers are quite alarming. And we've seen similar numbers from other research companies that do surveys. And when you do surveys, a lot of the times you get the politically correct answer, right? Because we want to be proud Canadians. When we see that survey come in, we go, yes, I'm going to buy Canadian. Well, then when I walk into the store, and no one's looking, or if I have needs, or if I have a child's birthday party and they want to have certain products, they're serving, well, sometimes we make choices that are a little bit different from our attitude overall. So the question is consumer behavior reflecting this attitude? And this is where NIQ can really, really answer that question quite simply. And it's a new capability that we launched in Canada. Actually, perfect timing for us. We just launched it in Q1 of this year, and it's called Nielsen Product Insight. And what we do here is that we're actually reading product labels. So think about the eyes of the consumer. When you pick up a product, you look at the front. Does it say that it's made in Canada? Does it say that it's made in the US? We also turn around the back of the packaging and look to see where it's also being made, or if it's a product as well. So from there, we're now able to determine whether or not consumer sentiment around, I'm only going to buy Canadian, or I'm going to avoid US products, what is it actually meaning at the checkout counter? And as you can see here, those attitudes are actually influencing choice as it relates to the retail store. So American-made products are down roughly about 7 percentage points. If you look at some of the individual months, it goes up and down, but it's basically been holding as well. And that made in Canada, product of Canada has been trending quite well overall as well. So these numbers, and you probably think back to the survey from the previous slide where we said about 16% of the people were only going to buy Canadian and 30% were going to boycott US products. Well, we're not seeing a 30% decline here for US brands because once again, it's survey based. And when you go to the store, consumers are still buying products whether they're aware or not aware of their country of origin. Now, these numbers are still very, very significant, and it's really challenging a lot of our clients as well to how are they going to grow with this new environment. So think about one share point in our industry is worth about $1.4 billion. So we've seen a big shift as it relates to US products moving their sales over to Canadian products within the grocery aisles. So the one qualifying factor that we also want to understand is, are Canadians willing to put their money where their mouth is? And so when it comes to buying Canadian in some categories and some brands, we tend to be potentially a little bit more expensive than, say, US products or other products from around the world. A lot of them are small, niche, local brands as well. And what we're asking here is whether or not consumers are willing to pay more for that Canadian product. Now, we do this survey once a year as well. So we were able to trend it versus last year to get a sense of how the sentiment has changed. So what we're seeing here, if you look at that dark blue, which refers to 2025, we're seeing that, we want to buy Canadian, but we're not necessarily willing to spend more for it. Maybe spend a little bit more. That 1% to 5% range tends to be that sweet spot. But if you think about the fact that, tariffs have been hitting a lot of products from a competitive perspective, we're not willing to spend that much more. And that's why we've seen a lot of manufacturers kind of absorb that cost point in order to be competitive from this price-sensitive consumer overall. So Nielsen IQ, we also are able to segment manufacturers into large groups. And obviously, when it comes to working with individual manufacturers, we report their overall corporate sales performance as well as their competitors. But for transparency for today, we're just going to talk about, the big players in the industry. And these are 5 different groups that we look at. And they roughly all have about a 15 to 20 share overall, just to kind of make them equal. So first of all, let's look at the growth in the middle. And we look at the top 20 manufacturers. So these are the big brands, right? The Nestle's, the Kraft, the P&G's, Unilever, Coke, Pepsi, they all fall in that top 20. What we're seeing is that growth is lagging. So at the very top, we have the overall market growth about 3.5%. And we see those manufacturers that are ranked 21 to 100. They're also lagging growth overall as well. They're still growing, but they're just not growing to the same pace as the overall marketplace is. And what we see in this is something we've seen as a consistent trend as we kind of navigate through 2025. Small players are definitely hitting above their weight class. So small is the new big when we think about growth in the grocery store right now. So those manufacturers that are ranked, 100 plus, and there's a lot of them. It's a very long tail. There's a lot of small players in our industry. They are contributing about 37% of the dollar growth in the industry. So retailers are really, really paying attention to these small players. They want to differentiate. They want to have those unique products in the store that drives in consumer traffic. Because if you have the same product everywhere, consumers will just shop based on price. So obviously they're trying to get away from that. They're trying to figure out ways that they can still be more profitable and drive their overall top line growth. And small brands are definitely help deliver upon that. Now that's the dollar store. But when you look at volume, we're seeing that the coin has flipped a little bit. So those, small manufacturers are still contributing to volume growth, where you see the top, 20 to 21 to 100 are actually contracting on a volumetric perspective. We see private label, those store brands are really bringing in the volume. We talked about right out from the get-go that consumers were feeling financially stressed, like they're worse off. They're buying on promotion. They're looking to shop at discount. So these are the retailer brands. So think about President's Choice. Think about Compliments. Think about all of those brands that are unique to a retailer, and they're bringing in almost 2/3 of growth as well from a volumetric perspective, and volume's up about 3%. Now, rounding out that unbranded thing on the bottom, you're kind of going, well, what's that? And think about the produce aisle, right? When you're in produce or buying random weight meat, a lot of those products don't have brands on them. It's like a grape, for example, or an apple that you're buying where it's a cost per kilogram, doesn't have a brand on it. So that is accounting for all of those produce items. And once again, we're seeing the produce aisle is doing quite well with that area of the store, the center, the perimeter of the store is up about 3.7%, and it's still contributing both on volume and tonnage growth, and volume is up about 1.7% overall. So just to kind of round out, and I want to leave some time for Sinead to ask some questions as well, is the big question that we're able to answer for our customers, and even probably for people on the call today, is are actions following words? And we know that this whole Buy Canadian movement sentiment is one that everyone's talking about. And the question is it being reflected in patriotic pockets? And the answer to that question is yes, it's definitely having an impact. We do see a negative growth on those, products that are made in the USA on food and beverage. If we think about year to date, it's down about 7%. Personal care products are down 4.5%. But once again, even though we're seeing declines here, it's not to the degree as we'd expect based on that sentiment overall. So we do see some opportunities and some trends for the industry to kind of keep an eye on. So this whole Canadian movement, once again, we haven't seen any slow of declines or Canadian products showing a slowing of growth. Whether or not it's going to be sustainable as we make our way through the next quarter, once again, it's all based on this relationship. And if I want to use that T word, Trump is basically whatever he continues to say is going to be the fuel that continues to motivate Canadians to continue to buy Canadian and avoid U.S. products overall. Now, even though we're kind of talking from an aggregate, it does depend on categories, right? So we dig into the categories for our respective clients. We do see these trends. They hold up overall, but there are some categories where U.S. products are still holding their own versus their Canadian counterparts. But one thing, you can't go all in with just one attribute. You can't say I'm a Canadian brand and therefore I expect consumers to buy me, right? And I like to refer to Canadians as patriotic penny pinchers. And you can want to buy Canadian, but once again, people want to receive good value for the money and receive a good deal overall, because we're still driven by promotional activity and getting the best bang for the buck. So we'll support our values as long as we're continuing to get value from an overall perspective. Another trend that we're going to continue to see is smaller niche brands are going to continue to win over consumers as retailers look to differentiate their assortment and win beyond price. And once again, this is just something that a lot of retailers and manufacturers are struggling with. They want to drive traffic to their store and they want to get your product in that shopping basket. But with 50% of all purchases being bought on promotion, it's important more than ever that once again you maintain a promotional strategy. So the biggest change we're seeing in the industry here overall is that we're not seeing promotions pull back, right? So right now there's a big push on margin. And obviously with trying to absorb tariffs and trying to figure out how we're going to push those price increases onto the consumer that's very vulnerable right now, one way to do that is to be more effective with your promotion. So what we're seeing is that promotions are still continuing. You probably got all your store flyers that started today, but we're seeing the depth of discount not go as deep. So an example would be that, in the past, it would have been a 20% discount. Now we're seeing maybe a 15% discount. Once again, it's still motivating consumers to buy, but then again, we're being a little bit more profitable with the margin, and that's potentially absorbing some of those increases and preventing them being passed on to consumers. Now, that discount retail format, that's something that's going to continue to expand from a share of wallet perspective. It's fueled by two things. It's fueled by push and by pull. By push, I mean by the fact that retailers, every time they open up a new store, in most cases, they're doing a store conversion to a discount format, or they're continuing to open up new stores that are meeting that need for consumers' value. Sorry, my Siri's watch just went there. Hopefully you didn't hear that. She thought I was talking to her. I wasn't. All right. And then obviously from a pull perspective, it's consumers. And consumers are just demanding, once again, lower price points and are voted with their wallets, and store traffic to those discounts is increasing. And the biggest watch out that we're really warning our clients with is the fact that we're continuing to see slowing of growth. Now, if we looked at our industry and how it performed over the last, 3 to 4 years since we kind of came out of the pandemic, we've seen, growth in that, that 1-2% volume perspective. But one thing we've seen, it's been lagging population growth. So in the last 3 years, we've had about 3 million new Canadians come into our industry. In the Canadian marketplace. In theory, there's more mouths to feed, but we're not seeing that 3% growth as it relates to volumetric offtake. And part of it has to do with the fact that we're seeing, other factors that's impacting slower levels of growth. We're seeing that consumers are only buying the essentials. Food is still doing well, but there's a lot of categories that aren't essentials that we've seen contraction on a volume perspective. We also have, consumers that are really struggling to make ends meet. So they could be skipping meals. They're just, once again, using food bank. Food insecurity is on the rise as well. And I think earlier this week, there was a Food Banks Canada put out a report about the fact that 1 in 4 Canadians are struggling to put food on the table. And food banks are seeing a record level of increase as well. So with the Canadian government putting a halt on immigration and slowing that growth of immigration, we actually may start to see a decline in volume, because even when we saw our population growing about 2 to 3% per year, our volume was still lagging. And now that it's expected to even level off or even decline, it's definitely going to have an impact on future consumption as well. So I know I took you through a lot of information today, and I wanted to leave some time for Q&A. But once again, if you want a copy of today's presentation or reach out to myself, or if you have any questions, you can scan that QR code and you can download a presentation. Now, Sinead, I'm going to stop sharing because I think you're going to bring up the slide that has the QR code so people can still grab the QR code if they want to get a copy of the presentation.
That is correct, Carmen. So if you come off screen share, which I think you've done, I'm going to flip over and see what our audience sees. So far they see me. How about if I go like this and back here? Hopefully you're seeing the slide with, yep, you are. Okay, great. Okay, good. All right. So yes. So thank you so much, Carmen. That was awesome. We actually do have time for questions, and a couple have come in. So what I will do is I'll read some of the questions that have come in. One of them was actually, would Costco be classified as a discounter? That's a good question. Is Costco lumped in with that discounter segmentation?
No. So from a point of sale information, no. So that's looking at retailer cooperation. So Costco is not a cooperator with Nielsen IQ. So that's our market measurement component. We call it our point of sale. So that excludes Costco. However, when we look at our consumer panel, we do capture sales within Costco, and we do consider them a discounter. Now, it's very different for them. Costco is a discount shopping for the rich. So if you look at the average transaction, you look at the household income, it skews to well over 100,000, like even 200,000 is the annual income that you see within a Costco shopper. So it's buying in bulk, obviously, is the saving strategy, forward buying, and getting a lower cost per use with it, which is a saving strategy. So in the data I showed with that 50%, that does not include Costco. But if we were to put Costco in the mix, obviously that number would be much, much higher.
Yeah, agreed. Interesting. I'm actually fascinated because, as you know, Carmen, I used to live and breathe this data alongside you, but I haven't looked at it in 13 years. It's been so long. And so seeing the growth of the percentage bought on deal is quite,
Well,
I mean,
and
it's
I
not
forgot
really.
to mention, the US number is 27. So Canada's almost twice as dependent on promotions. So this is, I think, what scares a lot of US companies, or even when you have a change in management, is how much a dependency is on promotion and how much money you have to put towards trade support. So what I mean by trade support is getting the display, you're basically paying to advertise your product in that retailer's flyer for the week. Retailers, obviously, that space isn't free, right? So they're looking to help grow your business, but they're selling you that space in order to promote your brand as well. So that's a big difference between Canada and the US. So theoretically, the costs of doing business in Canada are higher, not only from a geography perspective or higher incomes or whatever that is, but also higher trade support as well.
Right.
I'm
Okay.
going to mention one thing too. I'm just going to test you, Sinead, to see if you have what you remember. So Costco, right? So Costco, I think everyone loves Costco, and it's a retailer that's actually been doing quite well from an earnings perspective. This number always shocks people. What percent of Costco shoppers do you think are 1 or 2 member households?
Oh gosh, 1 or 2 member households. 50%?
Well, you're in the ballpark, so it's closer to like 55, 60%. It's in that range, because a lot of times people think Costco, it's for families only, and it's not. And the majority of people that go into Costco is like myself. I'm a 1-member household, or other empty nesters that have 2-member households, and the impact that has on our customers is the fact that when I buy a large size, well, guess what? You're not going to see me come back to the store for months later before I have that demand,
Right.
versus a family is going to be coming back more often. So we're also challenging, once again, to be very strategic with what you put in Costco, because, it's good to drive short-term share and volume, but then again, your consumer's gone. You're not going to see them for a longer period of time if you shift more volume to Costco.
Right.
And that's where, once again, you're trying to keep your consumer engaged. The frequency is obviously those visits important.
Yeah, that's interesting. One of the questions that's come that's kind of related to that is in terms of, elbows up, but buying Canadian, has that impacted retail price per product? So in other words, if you're buying Canadian, are consumers getting a good deal for their dollar? Do you have any thoughts on that?
Well, so you talked about StatsCan inflation earlier, and we put out our inflation numbers a week ahead of Costco, or it's not Costco, sorry, I've got Costco on the brain here, ahead of StatsCan, because we're getting our point of sale information from the retailers a week after the period close. So our inflation number is a little bit different, because we are tracking what consumers actually paid. And knowing that as consumers, because I think Stats Canada, they tend to look at a static basket of goods, right? And they're looking at that regular price point on a bulk. And we know that as consumers, we're constantly switching. We're buying on promotion, which theoretically is a lower price point. We're switching stores. We're buying larger sizes. So if you think about the Swiss Army knife of saving behaviors, Canadians on average are doing about 6 different things in order to save when they're going shopping. It's not just one. They're not just buying a promotion. They're thinking of all these other things that they can do in order to save. So we look at volume growth, and then we look at dollar growth, and we look at the gap between those two, and that's an indication of inflation. Is dollars growing faster than volume, which takes all those behaviors into consideration that tracks the inflation. So August came in for us at 3.1%, so very similar to what Stats Canada was saying. But when you kind of navigate around the store, there's a lot of red zones. So, meat's increasing. We're starting to see, what's interesting, dairy and refrigeration is starting to be we're not seeing the increases there, but we're starting to see produce and then baby care. Pet products is another one that's starting to creep up as well. So we're starting to see these red zones in the store, we like to call it, because I do this inflation heat map to show where's the pressure points. And obviously with something like chocolate that's gone up significantly, so if there are any chocolate lovers on the call, you can relate to this, right? It's costing you quite a bit more to buy chocolate. but we've also seen consumption go down about 9-10% on chocolate. So trick or treats around the corner. So kids are probably going to see less chocolate in those,
In their little baskets.
in their bag, in the
Aw.
baskets, because it's just become so expensive. I was in the store yesterday, those 100-pack you see are 90s.
Yep.
I saw them at Food Basics, which is a discount, and they were close to, like, it was $27. I'm like, oh, usually they're around high teens. So we're going to see a lot of inflation as it relates to Halloween, and maybe some shifts there as well.
Right. Okay. Interesting. Has credit card spending reflected in purchasing in the essentials? And I guess I can kind of take that one. And I don't know if you guys have credit card data specifically, Carmen, but in terms of purchase behavior for us, we do see that Canadians are spending more than they were last year, and it is on essentials. So those price increases that we're seeing, Canadians only, you only get so much money every payday, and you have to divide that paycheck up between my utility bill, my gas bill, my food bill, my rent. So I think you and I were chatting last week when we were talking about that, and we do see that Canadians are actually spending, I guess they're spending more, but they're getting less. And even as you indicated through some survey data, they're skipping meals. So yes, so we're seeing that.
Our data does not include, like, we capture the retail, what's being paid. So we don't get the source of payment. We're just capturing the fact that it's being purchased. However, we do some surveys around loyalty programs, right? And obviously there's a lot of credit cards that are connected to loyalty programs. So I like to refer to it as Canadians have become more loyal to being disloyal. So we want to collect our points, and collecting our points is basically any retailer you shop in Canada that you can collect points, right? So right now, Canadians are being very strategic. They're switching stores based on who has the best loyalty program for that week. They want to build up those points, and they are saving them up and they're cashing them in. So that's another saving strategy, is collecting points and then deducting them or using them to maybe splurge on something that may be more expensive and use their points for that.
That's awesome. All right. Well, we have only a few minutes left, so perhaps we'll wrap it up there. And I want to thank you so much, Carmen, for joining us. And to everyone who's watching, I hope that you learned something unique about the Canadian business environment, specifically grocery and retail, and how these insights can help you shape your risk strategies in real time. Thanks again also to Jeff. And Carmen, I knew inviting you in that this would be a real delight, and you did not disappoint. So thank you for coming in. On October 2nd, my colleague, Cheryl Prince, Director of Fraud Consulting, will be hosting our Fraud Trends webinar. That one too, if fraud is of interest to you. Those webinars, I always find them super interesting. And also big thank you to the team behind the scenes who keep these things running smoothly. But most importantly, thank you to everybody here for joining us today. Before I let you all go, a couple of things I want to mention too. We have the Canadian Scoring and Risk Strategy Conference coming up, and there are spots available, and you can get to see Jeff live and in person. So if you're interested in attending that, there is a registration link here on screen with also a 20% coupon code. So leverage that. And so thank you, everyone. We got 2 minutes left, just enough time to grab a coffee and start checking emails and catch up with the rest of your day. Thanks for joining.